Support and resistance. This is the most fundamental, most important ingredient in 99% of all Forex trading methods, and it is the basis on which all of our methods here at Forex Mentor Pro are based. Support and resistance simply refers to areas where price stops and rebounds. And for example, here on the US dollar Swissy chart, 4-hour chart from February earlier this year, you can see how price was coming down in a clear downtrend. However, I cautioned members not to be considering shorts at this point, i.e. to sell, because previously this area had been very important. All that we are doing when we are looking for support and resistance areas is looking back and seeing what happened the last time price was in this area. So, for example, on this pair, if we scroll back, I have scrolled back to September of the previous year, and look here how price came down, bounced off this area, bounced off this area again, and bounced off this area again. And therefore, in September, it was a major area of support where price bounced back up again. And therefore, lots and lots of traders are looking at this area because the simple logic of this, guys, is if it happened here before, then it's likely to happen here again. If we then move forwards to October, price came down, bounced off, it was a little bit messy here, but still failed to make the move further down and continued back up. Late October, we had the same scenario. Eventually, price broke and closed below. And this candle has to close before you start thinking in terms of support now becomes resistance. Because look what happens. Major important area where price has struggled since September. Price breaks it, comes back up, touches the area and turns back down. Support now has become resistance. And as we move forward in time, what happens? Late October, price comes back up to the area, resistance, it moves away again. Finally in November, after an initial rejection at the resistance line, price breaks through. Because price has broken through, resistance becomes support. And you see how the pattern forms, price comes back down, and for 3 or 4 candles, it bounces back off again. As this has happened on numerous occasions before, as we were watching price come down this area and we were looking for reasons to take a trade to sell, to go short, by looking back at previous historical evidence, we were able to see that this was probably going to bounce or at least struggle in this area. There was a further clue here, if you recall from the candlesticks video, that this is a tram tracks pattern which suggests price is going to move back up again. So that is support. This then is resistance. The same period of time, the euro versus the dollar, price came up and slammed into this area of 134.82 and bounced off. Above here we had the major psychological level of 13500. So if this was going to stop anywhere, this was a logical area. Once again, we have a scroll back to the left. And we see back in October, price came up to the area, hit it, and bounced off. Eventually price broke through, and therefore, as you know now, resistance becomes support. In November, price came down, touched this line virtually to the pip, and bounced away again. It then came down. Now this was messy, this is not clear-cut support, this was very choppy, and this would have been difficult to trade. But it was obviously price was struggling in the area. Finally it broke. Next candle at 1 comes back up and almost touches a line, and therefore support has become resistance. Once again, November and December time, price comes up. Even after a huge major move, where does price stop? Virtually to the pip again at this important area of resistance. And then it pulled away. Therefore, by February, where we were looking to buy the Euro USD in this move, the fact that this was a major previous area of resistance kept us out of a potential losing trade. If you are what is known as a swing trader, then you can use this information to then be selling the euro. In recent weeks, we have used support and resistance here at Forex Mentor Pro to help us to avoid more losing trades. For example, here on the Euro USD, when price started to get down into this area after a major fall, and I advised not to short in its current position. This is the Euro USD on a weekly chart, and if we scroll back, you can see how in April-May of 2010, price came down and touched this line on a weekly chart twice. It then broke through and therefore support became resistance. The very next candle was the resistance. It then broke back up again and set off on a move higher with a final touch back to this area. This is the Australian dollar against the Japanese yen, and once again we have a weekly chart, and going back to February 2011 you can see how important this area has been. Yes, there have been some nasty spikes which would have entailed losing. However, in general this area has been very important, and therefore for this 4 or 5 week period of time it kept us out of the potential losing trades, because probability said it would probably bounce back down again. Now that price has broken through, we are looking for clues now to long, and it doesn't look very big, but this particular candle, the red candle there, did move 80 odd pips, having pulled through back to the line and then moved up. Final one for now, this is the British pound against the US dollar on a daily chart, and at this moment in time we are not taking trades at 57.30, i.e. we are not going long. We do not wish to buy until or unless this area breaks, because you can see how on 1, 2, 3, 4, 5, 6, 7, 8, a dozen occasions in the recent couple of months price has failed to break and close above this area. Therefore, you can use support and resistance to keep you out of potential losing trades, and as I explained a little earlier, swing traders will use support and resistance to help them to enter a trade. So for example, each time had you shorted here on this particular candle, then the next candle down moved 100 pips. Had you done so again, it went hundreds of pips. And therefore the nice thing about this type of trading, you only need your stop above a recent high and you have the potential to make a decent gain here, because if we have a look at where price has been bouncing back again, price basically has been bouncing off this upper area and coming back down off the lower area, and therefore had you used this line to enter the trade and place your stop up above the recent high here, therefore you would have risked approximately 60 pips. Your target for this trade would be the lower level of support, and that middle figure there, 266. Ignore the final digit, this is a 5-digit platform, but this then is risking 60 odd pips for a potential gain of over 250, and therefore roughly a 1 to 5 risk reward ratio, simply from trading from support and resistance. In truth, you cannot trade solely from support and resistance, but you do need to master this, because this is the fundamental part of technical analysis for any kind of trading. Many people struggle with support and resistance. They struggle with the idea of where to place the line, and all you're trying to do is you are trying to replicate what everybody else in the world is seeing, and therefore it would be pointless to have a support line down here because there's no other support in the area. You're trying to look for a point where there are the most amount of touches, and then, as I showed you before, you scroll back to the left and see if the theory is supported. Now, it's not an exact science, and I believe this is why people do struggle with it, because here, yes, it was support and support, but then it was a bit wishy-washy, so it's not an exact science. But the best thing to do is, if you're not sure, is practice. Go back onto old charts, zoom out. If you go up to the top row on MetaTrader to the minus button, you can zoom out and then have a clearer look. So on here, for example, on this British pound, where else could we look for potential support? Well, if we look here here, then that is another area. And the other thing to bear in mind is that whole numbers are generally important areas of support or resistance. So this, for example, is 15400. A whole number. Has it been previous support and resistance? Yes, it has. And therefore probability says that if price gets down here again, it will probably bounce back off again. So if you were to enter a trade at 57.30, your overall target on this could be as many as 300 plus pips. If we were to move upwards and say if price breaks this current area, where is it going to stop again? Well, it stopped here before, it was support here, it was resistance, it was support. So 57.76 area is an important area. What you can also use support and resistance for example, had we decided to take the trade at 57.30, the area we were just looking at, then you can also use support and resistance lines for the area where you're going to place your stop to protect your trade. So assume that we are going to take a trade at 157.30. We would place our stop just above 157.70 to protect the trade. So we would go just above this recent high. Now you are able to calculate the potential risk reward of this trade. You are risking a potential 50-60 pips for a potential overall gain of 300 plus pips. Before you make any trade, you always need to calculate where to place the stop, and you always need to calculate where your potential reward will be. We'll cover this further in subsequent videos. If we go back to our 4-hour USD Swissy chart, and if you recall 89.30 was the major area of previous support. Had we had other clues to support the theory that we were going to now take a trade to go long, i.e. to buy this pair, we would be looking either for previous support as a potential stop, or in this case just below the whole number of 8900. Therefore we would go down to 88.90. You would be risking 40 pips, and you now have to calculate where you think that this trade is going to go to. Well, when price came down, you can see how anywhere around 90.20, 90.30 was important, and therefore it was reasonable to expect that price would get there again, and therefore risking 40 pips for a potential 100 pip gain, 1 to 2 risk reward ratio. Depending on the type of trader that you are, some traders will look to enter this type of trade and be looking for a much bigger move. They will have this trade in play for weeks and sometimes months. The next area of interest for a potential target, if we look at support and resistance, is anywhere around 91.30 area. Look how important here again support and resistance was, and on this occasion it worked perfectly. The next major line that we get up to is around 9300, and therefore if we go up to 9300 on this occasion it would have won, and therefore you would have risked 40 pips for an overall gain of 370 pips. Similarly with the Euro USD, at the very same time, I will cover this later, but when the Euro is going down, the Swissy is usually going up and vice versa. This is known as correlation. Had we been looking to short the Euro for a number of reasons, then here 34.80 I showed you before was the major area of resistance. If we don't have a recent candle for a high for the stop, then we would go to 35.10 for the stop. So a stop at 35.10 gives you a risk of approximately 30 pips. Where would you be looking for your first target? Hopefully now you start to see anywhere around here. It's giving you a potential reward once again of around 100 pips. As we move further down, we could be looking next around here. This one's a bit messy, but anywhere around here as a potential target, and an overall target all the way back down here. And price did eventually, I believe, many weeks later, did finally get back down there. In this video, I have shown you how we use horizontal support and resistance, how we can use it to avoid losing trades, how we can use it for entries, how we can use it for stops, and how we can use it for targets. There are other forms of support and resistance, and I will cover that in future videos.